I'm Dan Passarelli of MarketTaker.com here on the floor of the CME Group. Today we're going to be talking about Netflix, everyone's favorite streaming video source. Well, guess what? I was looking at a chart of Netflix earlier today. You should do the same. Take a look at a chart of Netflix. You'll see that Netflix right now is hitting some short-term support, and consequently its implied volatility is just a little up with the broad market's implied volatility, but especially since Netflix has had just a little bit of a rout lately. Now, as long as this route doesn't continue, this promotes a really interesting opportunity to sell put spreads. Why? Because, of course, with put spreads, as long as the underlying, in this case, Netflix stock, doesn't fall below support, the trade's a winner. Now, this trade is further made better because the implied volatility is high. When implied volatility is high, that means options are more expensive. When options are more expensive, when you sell them, you get more. So this is a great opportunity to potentially sell overpriced assets that have support, so therefore we have a history of buy orders at a particular level that may help keep the stock propped up and make our chances of being a winner on this put credit spread even stronger. So here's the specific trade that I like, that we talked about today in our group coaching class. The trade is selling the Netflix 185-190 put credit spread that expires on November 24th. So this is a weeklies option, okay? It expires November 24th. The whole idea here is you can sell that spread. At the time I'm recording this, you can get about 85 cents. I think as long as you can get 60 cents or more, I still love the trade. If you sell that, the most you can make is 60 cents, which is fine because this is a very high probability trade. Again, we're selling something that's arguably overpriced because IV is high. We're selling something that has support with a history of buy orders that can potentially prop the market up and make the trade a winner. So it's a real high probability trade, real strong trade. Here's how I would manage that. As long as Netflix stays above 190, there's no problem. Just sit and wait, and when you can buy back that spread for maybe a dime or so or a nickel or so, buy it back. Even if you're just buying back the short option because that's the risk in your trade, if you can buy back the 190 puts that you sold for a nickel or so, the trade's a winner. Take off the risk, take your profits, move on to the next trade. Now the problem could potentially come if the market continues lower or just Netflix continues lower and the stock falls below $190 a share. If that happens, we're going to have to regroup a little bit. We're going to have to take a look at some of the rationale why that is. As long as we think the market, specifically Netflix stock, won't continue even farther if it falls below 190, we can simply roll down to lower strikes and turn a losing trade potentially back into a winning trade. The only real problem comes, which is an unlikely scenario, but we have to watch the market. If Netflix really begins to rout and the market starts selling off strong, that's when, your first loss is your best loss. Take a loss on the trade and move on and wait until the market stabilizes, and then there's the potential to jump back in. This is Dan Passarelli of MarketTaker.com here on the floor of the CME Group. Trade well.